G'day folks, welcome back to another update, and today we're looking at the S&P 500 and the NASDAQ again. Now both charts are still cautiously bullish. I'll say cautiously, but be careful, we might see a bit of a retrace in the coming days. And I'll go through that, what that means. Before we go any further, make sure to hit that like and subscribe. So as of today, May 30th, market performance, the S&P 500 has gained approximately 6% in May, while the NASDAQ composite has surged about 9.5%, driven by strong earnings and optimism in the tech sector. In terms of tech sector leadership, Nvidia's impressive earnings, including a 73% year-over-year increase in data center chip revenue, have bolstered investor confidence and fueled the rally in technology stocks. Trade policy risks, ongoing uncertainty surrounding President Trump's tariff policies, including recent court rulings and potential new tariffs under Section 122 of the Trade Act of 1974, pose risks to market stability. Valuation concerns, the S&P 500 is trading at over 22 times 2025 earnings, raising concerns about market overheating and sustainability of the recent rally. And economic indicators, investors are closely watching economic data such as GDP revisions, which could influence expectations for Federal Reserve interest rate policies and impact market dynamics. So first we'll start with the S&P 500. We always look at the long-term trends first. So on the monthly, the price is still very bullish above the moving averages. But the notice we've got a bearish divergence here on the CCI 150, and that's broken below our moving averages. So that's a bearish sign. Now, this bearish divergence, lower highs versus high highs on the price, we drew a Fibonacci range. And again, I'll just draw that for reference. We take it back to that level. And the minimum retrace level we can expect is a 23-38% range of a divergence. And you can see here in the last few months, that wick of that candle broke into that range and then bounced out of there. So more than 90% of the time it hits these divergence retraces. Sometimes it breaks right through that 23-38% range. Other times it just does that like it did back here as well. There was another retrace, another bearish divergence, longer term, and that also bounced out of that 23-38% range. So the monthly is somewhat neutral to bullish, so just be cautious of that. We might see further declines. Otherwise, I'd like to see this break above the CCI to be more bullish. On the weekly, now the CCI is already broken above the moving average range, and so is the price, giving us a slight bullish momentum. We did have a bearish, you can see there that between that period, we had a bearish divergence, and that actually broke down quite strongly if I was to draw a Fibonacci down to that level. So that's already played out. On the daily, just be careful here, we've got a double top on the CCI versus slightly higher highs on the price, and that's a bearish divergence. So we might see it pull back, and if it did so, draw a Fibonacci on that one. Between that high, we'll take it back to that. I like to take it back to the recent low before the divergence started. So I'll take it back to that level first. And you can see there between that 23 and 38% range, that's the minimum range you can expect it to hit. It looks like it's on its way at the moment. Of course, the price can continue to rise, but as long as the CCI keeps dropping, we're going to consider that a bearish divergence. So that'll be the minimum retrace. Now, if it falls below that, we're going to expect it probably to come down towards this descending diagonal trend line, which happens to also coincide with a 50% retrace as well. So that's a bit of a, we'll take it one step at a time. Let's see if it breaks into this minimum range first. That's on the daily. Now, if we go to the 1 hour time frame, let's first look at the chart without the back testing. So again, we only take long positions predominantly, but again, what we're looking for here is on the 1 hour. Each of these divergences, by the way, they're all independent from different time frames. They're not necessarily aligned. So what I'm looking for here is any bearish or bullish divergence. So back here, we did have a bearish divergence, lower highs versus higher highs in the price. And if I go back, there was another bearish divergence there. So it pulled back. There was, it's a bit hard to see there. Let me just zoom in here. So a bearish divergence, we look at the highs of the CCI and the price. And a bullish divergence, we look out for any lows. So we look at the peaks there. You can see there, that's dropping versus the troughs there on the CCI are rising. So that's a bullish divergence. And that actually broke, if we drew a Fibonacci to that level, it broke more than 100% retrace. So that was an easy one. But again, more recently, we had a bearish divergence there. You can see there it's broken well below the 23-38% range. And you can see there those troughs are lower on the price and the CCI. So that's the CCI. Normally what we expect is a CCI to move in tangent with the price. And you can see there, these peaks and troughs are aligning with the peaks and troughs of the price as well. So there's no divergence that I can see there. Even those bottoms there, that's a double bottom, but notice there's higher bottoms there as well. So there's no divergence there. Now, if we go to the back testing, we only take long positions. What I've got here, the back test going back to around this period when the daily broke above the CCI 150 moving averages. Now notice here the price is still below. I preferably like to take when the CCI and the price are above the moving averages. So ideally you would have started taking trades from that point. But I've deliberately shown you this one here so to show you what can happen if you do go too early. So again, the back test here started when the CCI back here broke above. Sometimes it works, sometimes it doesn't. In this case, it wouldn't have worked because the price kept declining. And you can see here, this is the stop loss approach and this is the average down approach. And both strategies take profit at 3%. The stop loss approach stops at 5% loss or drop, and the average down waits for a 5% decline before adding more positions when the entry parameters are met. And the entry parameters are when I'll demonstrate here on the daily. The entry parameters is when the CCI breaks above the moving average, and so is the price. That's where you enter the trade on any time frame. So you can see here the stop loss approach dropped off straight away, and the baseline's 100,000, and it stayed below 100,000 throughout that whole period. Even though the price is rising, we never regained greater than 100,000. The average down, though, if you let it run right through the whole period, has generated 22,500. Now, be very careful with the average down because notice here, as I said, I'm demonstrating here deliberately where the CCI broke above the moving average, but the price is still declining. That's where you would have got hit with this drawdown. Now, during this averaging down, you would have averaged down a total of 15 contracts at that point. And from 100,000 baseline, you would have had a drawdown down to about 62,000. So you would have lost about $38,000 of your funds in your account. So you've got to be very careful how you treat the average down. So ideally, again, you want to make sure the price on the daily, if you're trading on the hourly, the daily is above the moving average, and so is the CCI and the price. And you can see there, had you taken the trades from that point, and that would have started from this area here, you may have you would have done a lot better. A bit of a drawdown there, not too much, with a bit of a retrace there. Another drawdown there, and another bigger drawdown there. But overall, the average down approaches work well. The other thing to notice as well is, you'll notice here, that one we explained, the drawdown there, you would have avoided by not entering too early here. This one, this drawdown, you probably would have closed out your trades once you started noticing, if I zoom in there. Let me just zoom in. You'll notice here we've got lower highs on the CCI versus higher highs on the price. So as soon as you start seeing that, you start seeing lower CCI movement. Ideally, probably should have closed out one of those positions after that area there, and that would have avoided that drawdown. Now, in this case, you were fortunate. The price did recover, so always focus on the hourly as well as the daily. So the daily is a general trend. The hourly is giving you a more micro view of any divergence. We always pay attention to these divergence, so you would have taken your profits. So you can see there, that would have been your first sign of a bearish divergence at that little peak there and that little peak there. They kept going, new highs on the price, new lower highs on the CCI, and so on until that point, and it finally fell off. Now, where are we at the moment? We had a bullish divergence here, higher lows on the CCI versus lower lows on the price, as we said. And in this case, again, it's recovered and did quite well. So overall, the average down approach has done quite well, just paying attention to any bearish and bullish divergence. Another bearish divergence here more recently, you would have got out of the trade. You would have had a couple of positions open there, but you would have got out there with a nice little gain. So this is the NASDAQ. Again, looking at the long-term trends first. On the monthly, we've got another bearish divergence versus the price, and that actually pulled back, and it's already hit, or also hit our target similar to the S&P. Now the CCI is slowly recovering towards that moving average range. Likewise, we had a nice bullish candle so far this month, near the end of the month. On the weekly, we had another bearish divergence. These divergences are independent from each other. In this case, they do align. We had another bearish divergence. The price dropped strongly, and it's now recovered. The CCI is broken above the moving average, and so is the price. So bullish momentum on the weekly, and on the daily, bullish momentum. But just do notice, similar to the S&P, we've got slightly higher highs on the price versus, we take it to the highest point there, versus that's about a double top on this CCI, and I consider that a bearish divergence. So again, similar to the S&P, I'd say that'll probably pull back to that level there, and that's our minimum target range, a 23-38% range. Just draw that there. That's our minimum retrace level. So that's what we can expect in the coming days. Now, it could fall a lot further, as I said, and if it does, then we look for the next Fibonacci level, which would be the 50%, 61%. If it breaks below that, it may come on a line up with this diagonal descending trend line. Now, if we go to the intraday charts, the 1 hour chart, again, well, I'm testing long positions, but be careful. This is about to break to the downside, I'd suggest. So if you haven't already entered the S&P, I'd sort of hold off and wait for this to confirm one way or the other. Let me just get rid of that. But what we look for here is any divergence. That's really what we're looking for. And we look at the peak here on the CCI, declining peaks on the CCI versus slightly higher highs on the price. Now, when these are very narrow ranges, often I find the retrace is a lot more volatile. In this case, a lot more stronger to the downside. And if you can see there, if you drew a Fibonacci to that level, that's a 100% retrace level already. Now, I go back here, just seeing if there's any other divergence to take note of. You can see back here we had another bearish divergence. So what I'm doing here is aligning it up with the high of the price to that point there. Now you'll notice here as well, just to emphasize, during the first, actually that would have gone back down to that level there. So we line it up with the CCI decline. So you can see there highs on the price, lows on the CCI. So to that point there, that was your first sign of a bearish divergence. Now what we look for is a significant break to the downside. In this case, the price kept rising, the CCI kept dropping. So you would have extended it probably to that peak. So you wait for another peak, and that would have been another peak there. So you would have extended it there. That's still a bearish divergence. The CCI kept dropping, and then another peak there, and that's where we are today, or that's where it was at that stage. And then it finally broke further to the downside quite strongly. And if we were to draw a Fibonacci retrace at that level, like that, you can see there it broke at the 38% level almost perfectly, then it bounced out of there. Now, again, just be careful though, we've got a bearish divergence on the daily, which means we may see further declines on the price on the the NASDAQ. If we go to the back test, and this is very similar time frame or the time period on the S&P 500. So we started the back test where the CCI broke above the moving average band. Now you'll notice very similar to the S&P, the price kept dropping, although in this case the way this works, sometimes the candles on the charts are a bit different nature. They're all like a snowflake, different fingerprint if you like. Again, the baseline's 100,000. The stop loss approach is generated minus $320 odd, and the average down approach, if you let it run through the whole period, and I'm not suggesting you do that, you pay attention to any divergence, that would have generated 10,372. But again, just do notice that we've got a bearish divergence on the daily. The hourly is dropping off, it's bearish, so don't go long. I'd like to see this break a lot higher than the previous high there, in which case you then can start taking long positions. Also note on the daily as well, with the NASDAQ, I've got this resistance up here at 225, excuse me. So if that breaks through there, we'll see, by that stage, we'll see higher highs on the CCI as well, most likely, unless this starts to drop. And if it starts dropping, be very careful, don't enter any long trades. So if you're new to trading, we're now including a video series, Pete's Investing Plus One, as part of the Pete's Investing channel. The Plus One videos are a dumbed down version of our strategies and give you a better insight into our analysis and help you follow our daily videos. If you enjoy the content, help keep me motivated to keep doing these videos, subscribe at least on a free trial to my Patreon page, where I publish weekly bullish shares across various regions of the world's markets. Thanks, and talk to you in our next video.